Hey everyone, hope you're doing well. Today we're going to talk about the big topic that a lot of people should be paying attention to going forward, and that is how the markets in Japan are affecting all of global markets right now. More specifically, it's about how the Japanese yen carry trade has brought a new big catalyst, both negative and positive, into markets. I've got a lot of interesting data points to show you guys today, and I'll also leave helpful links in the description below. A lot of things are happening in Japan right now. There was a serious megaquake warning issued recently as well. Hopefully it doesn't turn into anything serious and everything will be okay. As for markets, the interesting part that I'll share up front is that I think discovering the problems with the carry trade is now a positive for long-term investors. And in this video, I'll explain why. A lot of moving parts, always changing, so be sure to follow my latest thinking on Substack where I publish Monday through Thursday. So let's get into it. One of the biggest catalysts behind the recent surge in market volatility since late July is the rapidly rising value of the yen, which has been weak for years because the Bank of Japan's easy monetary policies. Because of the weak yen, a group of large institutional investors have decided to employ what is called the carry trade, which in simple sense is borrowing the yen, which has been at super low interest rates, and then buying currencies with higher yields. This was a popular trade because Japan held negative interest rates for quite some time. A carry trade involves borrowing and selling one thing, and then taking that cash and buying something else, hoping to earn more from the asset purchase than it costs to borrow the other one. Traditionally, the yen has been the funding currency for carry trades in the US dollar, Mexican pesos, and New Zealand dollar. In terms of what investors could have expected historically, annualized returns were around 5 to 6% on dollar-yen carry trades, which is the difference between the US and Japanese yields. If the yen were to weaken more during that period of time, there's more potential for gains in the carry trade. So let's briefly talk about where this trade originated from. After the asset bubble burst in Japan a few decades ago, policymakers lowered interest rates to 0%. In 2013, Japan's then Prime Minister Shinzo Abe accelerated the yen's decline by implementing massive QE in an attempt to revitalize the economy and inflation. About a decade later, Japanese investors have been accelerating their investments abroad outside of Japan as the US Fed raised rates, but Japan decided to keep rates close to zero. That leads us to the next question as to how large is the carry trade? Well, there isn't an exact figure that we know for sure, but we can make some estimates based on loans taken out by Japanese banks on the yen. Now, Reuters reports that 350 billion of short-term external loans have been taken out by Japanese banks. That's one way to look at it. But another proxy is the size of Japan's foreign portfolio investments. That size is a lot bigger at 4.5 trillion. Now, if we compare this to the total world's stock market capitalization of 110 trillion, Japan's foreign portfolio investments may seem small. But the one thing that we don't know about, and that's why investors were nervous, is exactly how much leverage is in the system. If there is a lot of leverage in the system, the carry trade could be percent of the stock market capitalization that could cause investors to be nervous if the yen were to make significant moves. The entire system has been unraveling over the past month, with the Bank of Japan raising its interest rates to 0.25% for the first time in decades. Meanwhile, the US Fed is now expected to cut rates. Now, I've got more good news on this, but first, our video partner is going to help my viewers make the most out of their resources during these turbulent times. So one of the things that I think will help all my friends on the channel is to have tools that can help one make the most out of their resources. Sometimes money is being left on the table if one isn't maximizing points from our credit card spend. That's where today's video partner comes in. Let me introduce you to Kudos, a free AI-powered smart wallet that helps you unlock more rewards and benefits from your credit cards when you shop online, all for free. Think of Kudos as Rakuten, Credit Karma, and Apple Pay all rolled into one powerful tool. Let me break it down for you. First off, Kudos is like Rakuten on steroids. It helps you pick the best card to use at over 2 million stores, guaranteeing that you'll always earn the highest reward points or cash back. You can also earn extra rewards shopping with Kudos. For example, during this past July 4th, Kudos offered up to 25% back at sites like Priceline. That's 4 times higher than the 4 to 8% you typically get with Rakuten. Now, Kudos is also like Credit Karma in that it helps you discover new credit cards. Thanks to their exclusive partnership with the Points Guy, you can access the best welcome bonuses available. It's like having a credit card expert in your pocket, always on the lookout for the best deals. Kudos is also like Apple Pay. Just select the credit card you want to use when you shop, and Kudos will autofill your credit card with just one click. It makes online shopping super easy and secure. The best part is Kudos is completely free. You get all these amazing features without spending a dime. Start earning more credit card rewards, points, and cash back by clicking the link in the description below and sign up using my code Larry. When you do so, you get $20 back after your first eligible purchase. It's that simple. So over the span of a few weeks, the yen has appreciated nearly 10% against the dollar, which is a monumental move in the world of currency pairs. Higher rates typically boost the local currency because you have to own the currency in order to purchase bonds. So this dynamic moved the yen much higher. Meanwhile, here in the US, many of us are now expecting interest rate cuts and moving into an easier policy cutting cycle. While this may or may not seriously weaken the dollar, at the very least, it limits the dollar's upside absent other catalysts. So what happened since the Bank of Japan raised rates was severe market turmoil in Japan, where we saw the Nikkei post its largest single-day loss since 1987. And this spilled over into global markets in the US and Europe. Now, a lot of people may think that this isn't a big deal because markets bounce back. And for most of us who are able to hold through, you're absolutely right, it is not a big deal. But because Monday, August 5th, 2024 was a very large liquidation event and will go down in the history books as a record event for markets, a huge number of margin investors were completely closed out right before the market recovered. Lots of call options expiring for that week went completely worthless. A lot of put sellers who use margin and leverage, they got in trouble that week as well. So these past several weeks has been a huge deal to different types of investors. And if you survived it, congratulations, because not everyone could hold through that entire week and ride the recovery. So the good news is that within the Bank of Japan, one of their deputy governors has decided to walk back some of the rate increase commentary that roiled markets. Specifically, he said that the Bank of Japan is unlikely now to raise rates when markets are unstable. This caused markets to stabilize after his comments that the yen isn't likely to further disrupt the carry trade that many institutional investors have employed. So there are a couple conclusions that we can observe from the latest market disturbance caused by the Bank of Japan. First, a lot of deleveraging has probably already happened, and that's a good thing. JP Morgan estimates that it's possible that up to 75% of the global carry trade has already been cleaned out. This is good because it actually reduces the chance that the worst case scenario can develop if this trade were to grow in size. Another report from investment firm ING estimates that the average cost basis of long US dollar yen carry trades is in the 152 region from the first half of this year. This means that the more time the yen can stabilize in this area, the larger the window that investors have the opportunity to exit this carry trade in an orderly fashion. I've linked their research below if you want to read it. Second, investors are already looking for safe havens after the unwind of the yen carry trade, and we're seeing the Chinese yuan appreciate back to yearly highs. This is potentially a good development for China because the PBOC, which is China's central bank, can now use monetary easing to lower interest rates without weakening their currency beyond their preferable threshold. These recent safe haven flows have strengthened the yuan, and this gives China some breathing room to ease policy if they want to. And if China were to ease policy, this could add global growth back into the equation, and that would benefit everybody, the US, Europe, China, and also Japan. And finally, because the leverage from the yen carry trade has somewhat been reduced from this episode, the sell-off in the US indexes, the NASDAQ, the S&P 500, have brought these indices back to levels where they can potentially work higher from here as long as we remain in an economic Goldilocks scenario. So on Substack, where I get to publish more frequently, I released several key pieces to help my members navigate this turbulent time. During the week of the Japanese market crash, I talked about how a very powerful recovery may happen once the dust settles. And once we got an ounce of recovery, I talked about the pathway on how we could recover a significant portion of July and August's declines. So my Substack is increasingly focused on finding undervalued stocks within the indexes to help readers find where the opportunity is during these uncertain times. So the bottom line is that because this crisis unfolded, investors have now paid more attention to risk management related to the yen carry trade, and this potentially cuts off a big risk that could have had even more disastrous consequences going forward if left unchecked. The thing about the yen carry trade is that the monetary policy shift from the Bank of Japan happened when the US markets were already undergoing a deep pullback phase. The Nasdaq was already near correction territory before the carry trade crisis added on another 6% intraday drawdown during the Black Monday crash for the Japanese Nikkei index. If the Bank of Japan raised rates to strengthen the yen 10% suddenly while we were at all-time highs, I think the outcome could have been far worse because the reaction may have been much more disorderly. So had the carry trade gone wrong while we were in a state of euphoria here in the US and completely off guard, I think the panic could have been much more severe. So the good side of this is that we are now aware of a problem that is currently being actively managed. It is still a big risk to monitor, but one that I think is manageable because the policymakers have made it very clear that they're not going to rock the boat too hard. And this sets up better days ahead. I'll have more market updates on Substack, so make sure to join me there. Thank you so much for liking and sharing my videos. Thank you to Kudos for helping my viewers save money during these turbulent times, and I'll see you next time. Have an awesome day.